something I love to do as the One Rental at a Time brand is growing is I love reaching out to new members who may become part of the One Rental at a Time family. We've got one gentleman here from Kearns Capital. Justin, how you doing, buddy? What's going on?
Doing great. Thanks for having me on the show. Happy to chat hedge funds and all kinds of stuff in the investing world. It's going to be a great time.
There you go. Well, I got to tell you, I have of all my contributors, I have no hedge funds. I have a 10-year Wall Street veteran who's now doing some ETF stuff, but I have no hedge funds. So, Justin, before we get started, introduce yourself to the audience, who you are, what you do, and then we can get into the first topic.
All right. My name's Justin Freistadt. I'm a managing partner and also president of sales at Kearns Capital. We're a hedge fund structure, 506C, which means we only work with accredited investors. And what's a little different about the hedge fund space is when you invest in a product like ours, you're actually a partner of the fund. You're not necessarily an investor, you're actually a partner. So that's what's a little bit different about typical investments versus going into the private placement space.
Very cool. So I think a lot of people hear the word hedge fund. Um, they think they know what it means. I think most people are probably wrong. Since you're in the business, this is what you do. Why don't you define really what is a hedge fund, and then we can go from there.
Yeah, the hedge fund is basically the Wild West of the investing world. I mean, I don't know any other way to explain it. It's the most least regulated, gives you the most flexibility to go out and do real world deals. So that's why the structure and the regulation on who can invest in these products is very tight, and we are very regulated in a different way as far as how we can raise capital, what we can talk about, things like that. But really, in concept, a hedge fund, there's tons of different types. Some of them are in real estate. Some of them are doing quant algorithmic trading like us, right? So a hedge fund can invest in whatever it wants, and then it raises capital from limited partners to go in and invest in these different products as an inside team. So what it's doing is it's bringing you closer to the actual source of the investment, which makes much higher returns than if you're investing in a derivative out on the public market.
Right. Is it one of the things, again, I think when I think hedge funds is they can and often do sometimes bullish, sometimes bearish, sometimes calls, puts. They're trading on very they go lots of different directions and they can change their mind in a moment's notice. Is that fair to say?
Yeah, I mean, that's exactly right. So in our fund one is a trading strategy, which means anything within the realm of trading, we can change the strategy on a dime. We can reallocate how the funds are placed. And it's a constant thing every day to manage the funds to make sure that we're positioning the partnership in the best possible place to beat the benchmark and also protect the downside. So specifically in our strategy, we're using algorithms to trade currencies and commodities. It's AI-driven technology. So what it has is a 1.3% max drawdown, but it has very high predictive capability. So when it's doing high frequency trading and a trade's going against it, it knows how to abandon it quickly, and it knows how to let it ride when it hits its target. So I mean, if you have that bottom stopped out and then you have a target on the upside, you can get a very tightly managed return. And what's beautiful about it for our strategy, makes me sleep well at night, is knowing that all of the money is in cash every day. It goes into the algo, it trades for a very short period of time. We're talking 3 seconds to 90-second trades.
Wow.
And we execute that strategy for a couple hours every morning. Then we're back in cash. So we're not exposed to geopolitical events overnight or any type of market fluctuations that are out of your control.
Oh, that is, yeah. You trade when the window's open and go flat at the end of the day, and come back the next day. I think is a genius move. Let's talk about this word you've used a couple of times, because again, I know what it means. Others may think they do, but not. You've talked about funds. You've talked about investors being partners, and then you've talked about funds. You probably have multiple funds, so not all partners are part of all funds. So talk about what a fund is, and then how an investor would be a part of that.
Right. So for us, we're a 506C, which means we only raise money from accredited investors. So what that means is to be accredited, the SEC requires you to have $1 million net worth, excluding your primary residence, or you can qualify as accredited by income. So if you have gross income of 200,000 in the previous 2 years, then you're accredited. That's if you're single. If you're filing married, it needs to be 300,000. So that's the qualification. If you don't meet those requirements, we're not allowed to take capital from you. And that's just the SEC's way of trying to create a barrier of entry to say, like, if you're going to invest in these complex private placement products, you need to have a certain level of acumen, right? So that's what that is. But I mean, our structure, 506c, we're a fund. The way it works is if you wanted to invest, you would complete what's called a PPM, private placement memorandum, which is, gives you the whole subscription document, what you're investing in, what the risks are, and how the investment works. For us, we got a 1-year hold on the principal when you come in. You can take quarterly distributions if you'd like, right? So it's a flexible vehicle in the sense that at any time you could say, I want this just to compound and grow. And then let's say you want some cash flow for home purchase, car, whatever it is in your life. Each quarter you have the option to say, okay, I want to take some gains off the table. So for me, it's more flexible than, let's say, a real estate investment where I know the money's going to be locked up for 5 to 10 years and I don't have access to liquidity.
Yeah. And again, a fund really is, like, let's just say Kearns Capital. I'm not saying you have this, but let's pretend you have 3 different funds. They're all doing slightly different things. I could invest in one and not the other 2. I would thus be I would have at risk or profit from fund 1, and I would get nothing from the other 2 funds. Is that fair?
Yeah. So for instance, our private equity fund's a completely different structure. It's based off of what the opportunity is. Like we're in the middle of raising right now for a pre-IPO opportunity. We haven't officially announced it, so I'm not going to say the name of the company, but essentially what's happening, this is really, really interesting. So within these raises of these monster companies, we're talking about a company that does $6 billion in revenue, right? Big investors like SoftBank has $1 billion in this thing. And we were able to find a distressed fund that has shares that needs to liquidate quickly, right? So the last round of funding for this pre-IPO is at $14 a share, and we are buying after that. We're getting the shares at $8, right? And they're valued at 23. So imagine being able to acquire shares at an 80% discount before a company's going public in the next 6 months to a year. So that one, there's no liquidity until we have that liquidity event, right? So you're investing in this pre-IPO and your money's locked. There's no cash flow, nothing like that. But in a 1, 2, 3 year time frame, that's going to sell at a 3 to 5x.
Yeah. Yeah. And again, what you're talking about there, again, using some of the vocabulary that maybe heard on my channel, is something potentially called a down round, right? There's a lot of private companies today. We've heard from the All In podcast, obviously, talking about some down rounds. I think, I was going to say Airbnb. That's not right. Instacart had a pretty big down round here in the last, 9 months or so, but that is obviously a risk that could happen. But this is exciting, because I keep telling people, in recessions or in bad times, good assets are sold by distressed sellers, because at some point in time, cash is the answer. And if you're in this fund at 14, but you need to raise because your other stuff's burning up, you'll take 8 just to get the 8 in cash because you have a bigger need for it. So that's just another example of somebody being prepared, and they can say, yes, this is Warren Buffett getting, getting Goldman Sachs to give him 10% plus warrants. He had the cash. Goldman couldn't go anywhere else. This is what happens when you have stacks of paper. You can sort of negotiate your own terms.
Exactly.
Yeah, so this is going to be fun. What other stuff are you seeing out there in the world? I'm actually seeing one of the things that I suspect is going to happen. If you don't play here, it's fine, but I'm going to ask anyway. I see a lot of distressed debt out there, especially in the commercial real estate market, right? That has to be trading at discounts already. There's got to be some paper out there selling at 60, 50, 40 cents on the dollar. Somebody doesn't want to go through foreclosure, but wants to raise the capital. Are you looking at the debt markets at all, or is that maybe a place you don't play?
It's not a place that we currently play. I mean, personally, as an individual investor outside of the hedge fund, I am pretty heavily invested in multifamily real estate. So I can tell you a little bit about what's going on in that market. The commercial office space, I'm terrified of that space. It's just too cyclical.
It's so bad.
Yeah, and it's not looking good, right? And it's also a threat to multifamily, because multifamily right now is trading at a 20% discount from the top, right? Because of rates and And I was just at the multifamily wealth conference here in Vegas about a month ago, and the consensus, some of the smartest minds in the space think we got another 20% downside before it's all said and done. So,
Yeah.
but that doesn't mean that there aren't good opportunities, right? Like if you can, if the way you want to invest in real estate right now is you have to do creative financing, you have to be assuming these loans. If someone's got 3% in place and you can buy it at a 20% discount right now, I think that's a great move, right?
Yeah.
Um, am I investing in any real estate with rates at 7%? No,
Mm.
so it's all nuance. If you buy it right and on the right terms, I think it's still a good time to buy real estate. There's a lot of inventory coming online because a lot of these syndicators, because margins are getting squeezed, they're all moving into development.
Oh.
So we're going to have a lot of units coming online, and then that
Yeah.
commercial office space could potentially be rehabbed into multifamily, because what are they going to do with it all? So I think there's a lot of threats in real estate, and
Mhm.
but it's still the safest, in my opinion, long-term place to store your capital.
Yeah, one of the areas of multifamily that I think is actually a side risk, and I got this from one of my bankers. Um, every year, if you're in commercial, at least every year, sometimes every quarter, you've got to go show the statements, the P&L, all of that stuff. So we did the song and dance like we always do, and at the end of it, he said, "Hey, can you hang back?" I said, "Sure." And he pointed at a Manila folder on his desk, and he said, "I can't refi half those loans." And again, I want to be clear, those loans were all performing. The bank needs cash. And I actually think one of the biggest problems is office is so bad that you're going to get so much extend and pretend. They don't want to take the 60 to 70% haircut, but they got to raise cash somewhere. And I think multifamily could be that spot that says, "Sorry, guys, I got to clean up my loan book. I need some cash.
Yeah.
Here you go." I think multifamily is the cleanest shirt in a dirty pile, but unfortunately this time, because you are the cleanest, you're going to get some operators who have to sell that didn't expect it.
Yeah, it's already happening. There's
Oh,
distress. There's distress in the space. I mean, if you're new in the space and you were buying at the top on a bridge loan or
oh,
adjustable rate, I mean, there's a lot I'm hearing of people that are already getting
yeah,
liquidated, that are losing 100% of their investment in some of these bad deals. So to
yeah.
your point, I think it's probably just getting started.
Yeah, we're in the first inning, and I want to go back to the deal that everybody in the space knows, that 3,200 units in Houston. I'm sure it was the talk of the town when that you were at that conference. That deal burned $100 million of LP money. I think the banks took like a 15 or 16% haircut on the debt, but there's a lot of LPs who've already lost their money and they don't know, right? From deals that were done in the last 2 year, bridge debt, bad assumptions, inexperienced operators, and it's gonna be hard to watch, I think.
Yeah, I'm seeing it across my portfolio and some investments. Mostly the A class space is getting hit the hardest.
Yeah, yeah,
Yeah,
yeah.
but then
Go ahead.
yeah, I mean, just cash flows are getting compressed. I mean, I don't have any deals that have gone bad yet, but I am seeing cash flows get hurt. I had one deal that they had to buy rate insurance and they did a refi, and now we're stabilized again. But it's getting hairy out there.
Yeah, I think there's again, shout out to the rest in peace Sam Zell. One of the things I love about Sam Zell is he was just always direct. I think would be the best way to say it. He was interviewed about a month before his passing. And I think it was on Bloomberg, and the person interviewing him basically said, "Sam, aren't you excited? This is what you went through basically in the SNL crisis. You were the original grave dancer." And Sam Zell looked over at him kind of slant eyed and basically said, "You're an idiot. We are so early in this process. We're years away from me getting excited." But he did think pain was coming. But um, what do you think? I mean, this is going to be years in the making, I think.
Yeah, it's hard to know. One of the things that I thought was very interesting about trends. This is like it's going to be such a story of different markets, I think. Um, the demographic trend of migration is the
Mm-hmm.
stickiest, most predictive measure in real estate. It's like a 50-year cycle. When people start moving,
Mm-hmm.
uh, it's a very long process, according to this demographics expert that was at the conference. I thought it was extremely interesting. You know, I'm out here in Vegas. I just moved here, and it's one of the most overvalued markets in the country. But this trend of migration here is not going to end, and there's only so much inventory. So it's this double-edged sword of, are we going to get this big pullback? And hopefully we do, because I want to buy. I was doing that. You know, the cost to own versus the cost to rent is the most dislocated it's ever been in market history. So I wasn't going to buy a house. I'm renting this house, and I'm waiting. You know, like, for me to own a primary residence, I just, first of all, don't think it's necessary to own your primary. And if you are going to own it, it's got to be a good deal. And right now, buying a house is just, the value proposition isn't there.
No, I totally agree with that. Again, one of the things I think that Sam Zell taught us is patience, but then also taking action when you know, the opportunities are there. I think there will be some time. Again, I think we're in the first inning. My current gut, and this could change at a moment's notice, kind of Q4, Q1, we start seeing more of really where the distress is, and certainly by a year from now, so next summer, I would love to be putting some capital to work in some bigger opportunities. That's what my current brain is, and I look every day. How does that feel to you?
I mean, it just makes complete sense. Oops. Did I lose you? There we are.
Nope.
Yeah. So, I mean, no, it makes sense, right? When you look at long-term credit cycles, I mean, there's only one way for it to go. I mean, liquidity, the Fed, I mean, everything, they're pulling money out of the markets. The rates are going up. They need to slow this thing down. It's like they tell you what they're going to do. And for some reason, we all just think this bull's just going to go forever, just because they're going to print, just because they lifted the debt ceiling, just because of, you know, you can find a reason to be hopeful, but the reality is that credit cycle is ended, and we're contracting. And to your point, when you look at the curve and you look at, you know, modeling of 2000, 2008, like, we are just on the beginning of this thing. And I think any shot forward is just a bull market rally or bear market rally.
Bear market rally. Yeah. It's going to be interesting, folks. We're going to talk about accredited investors, their appetite. We're going to talk about risk in the next couple of episodes. But if somebody wanted to check out Kearns Capital, where do we send them? So
our website is kearns.capital. There's no .com on the end of it. And, you know, so
Kearns.capital.
Yeah. My personal website is toptierhuman.com. And we're all over social media. Instagram, you can find me there, Justin Freistadt, and Kearns Capital.
Awesome, buddy. Thank you so much.